March 10th, 2000. The Nasdaq hits 5,048. A 25-year-old day trader named Nick Burbus is holding volatile tech stocks for an average of 4.5 minutes and pulling $10,000 a week. A college dropout is cold calling strangers from a boiler room in Long Island, selling penny stocks that will be worthless in 6 months, and he's buying a BMW with cash. Stephan Paternotte, co-founder of theglobe.com, is worth $100 million on paper. His company loses $2 for every dollar it earns, but nobody cares because the stock went up 606% on the first day of trading. Everywhere you look, ordinary people are becoming millionaires instantly, not through decades of compounding returns or careful portfolio construction. Instantly. One IPO, one lucky stock pick, one day of trading, and then it stops. By October 2002, the Nasdaq has collapsed 78%. Paternotte is asking his parents for rent money. The day traders are bankrupt. The boiler rooms are under investigation. Trillions in wealth evaporate. But here's what should terrify you about this moment. The pattern that created those instant millionaires, the rare technical formation that appears right before markets go vertical and ordinary people get rich in days, not years, it's forming again right now. And if history is correct, we're about to watch the exact same psychological sequence that destroyed the last generation of instant millionaires repeat itself in real time. There's a specific stock market formation that appears before explosive wealth surges. It's not a theory. It's documented across multiple historical episodes. The setup has 3 components: sustained low volatility, massive retail inflows, and a sharp vertical acceleration in price. When these 3 forces converge, markets don't just rise, they melt up. That term, melt up, describes the final parabolic phase of a bull market where prices climb almost vertically in a compressed time frame. It's not gradual, it's not rational. It's a psychological stampede. The most famous example is 1999. From October 1998 to March 2000, the Nasdaq rises 270%. But the real acceleration happens in the final 6 months. From October 1999 to March 2000, the index surges 100%. That's not a bull market. It's a mania. And during that final surge, ordinary retail investors pile in. They're not professional traders. They're secretaries, teachers, truck drivers. They open online brokerage accounts. They quit their jobs to day trade from home. They believe the rules have changed, that technology has created a new economy where old valuation metrics don't apply. This belief isn't random. It's reinforced by media coverage, by celebrity analysts on CNBC, by neighbors who are getting rich. The psychological pressure to participate becomes overwhelming. It's called FOMO, fear of missing out. And once FOMO takes hold, price momentum becomes self-reinforcing. People buy because prices are rising. Prices rise because people are buying. The feedback loop accelerates until it breaks. But here's what makes a melt-up dangerous. It doesn't feel dangerous. During the climb, volatility is low. There are no crashes, no sharp declines to shake out weak hands. The market just grinds higher, day after day, creating the illusion of stability. Investors interpret low volatility as safety. They think, if the market were overvalued, it would be dropping. So they buy more, and the melt-up continues. The 1999 melt-up wasn't smooth, though. Even during the final surge, there were multiple declines of 11% to 14%. These weren't crashes, they were normal corrections within an uptrend, but they were violent enough to scare traders. The key lesson: melt-ups are volatile at the peaks. The smoothness is an illusion. The closer you get to the top, the sharper the intraday swings become. Historical data shows this pattern isn't unique to 1999. Similar formations appeared in the 1920s before the 1929 crash, in the 1840s during the railway mania, and in the late 1980s before the Japanese asset bubble burst. Each time, the same 3 elements converged: prolonged low volatility that bred complacency, massive participation from inexperienced investors convinced they'd discovered easy wealth, and a final vertical surge that defied all traditional metrics. The pattern is cyclical because human psychology is cyclical. Greed and fear operate on predictable timelines, separated by just enough years for new participants to enter without the scars of the previous collapse. Retail investors are the fuel for melt-ups. Without mass participation from ordinary individuals, the parabolic move doesn't happen. Institutional money, hedge funds, pension funds, sovereign wealth can't generate the velocity required for a true melt-up. Institutions are too cautious. They have risk limits, compliance departments, redemption pressures. Retail investors have none of that. They're betting with their own money, often with leverage, and they're driven by emotion rather than process. In 1999, retail participation exploded. Online brokerage accounts surged. E-Trade, Ameritrade, and Charles Schwab reported record new account openings. Day trading became a cultural phenomenon. News documentaries featured people like Nick Burbus, the 25-year-old who boasted of making $10,000 a week by holding shares for minutes. The narrative was simple. Anyone with a laptop and an internet connection could get rich. This democratization of speculation was structurally new. Before online trading, retail investors had to call brokers, pay high commissions, and wait for execution. The friction limited participation. But by 1999, you could trade with a few clicks, pay $10 per trade, and see real-time prices. The barriers collapsed, and millions of people who had never owned stocks suddenly became active traders. The same dynamic is happening now. Retail investing activity in 2024 has surged to levels rivaling the pandemic savings boom of 2020. Younger demographics, particularly adults under 35, are entering the market earlier than any previous generation. They're using the stock market as a primary wealth accumulation vehicle, not a long-term savings tool. They're trading options, leveraging positions, chasing momentum stocks. The behavior mirrors 1999 almost exactly. And just like 1999, the retail surge is being enabled by technology. Zero-commission trading apps, fractional shares, 24/7 market access through crypto and international exchanges. The friction has been removed again. The only difference is scale. In 1999, maybe 10 million people were actively trading. Today, it's closer to 50 million in the US alone. The fuel is bigger, which means the melt-up, if it happens, will be bigger too. The data reveals something darker. Retail investors consistently enter markets near peaks. They're not early adopters, they're late arrivals, attracted by rising prices and stories of easy wealth. By the time ordinary workers feel confident enough to risk their savings, professional money has already accumulated positions at lower prices. The retail surge marks the final stage, the moment when insiders begin their exit. This isn't exploitation in the traditional sense, it's the natural conclusion of every speculative cycle. Retail investors provide the liquidity that allows smart money to sell at inflated prices. Recency bias is the belief that recent trends will continue indefinitely. It's the psychological flaw that turns investors into speculators, and it's the engine of every melt-up. In 1999, recency bias was total. The Nasdaq had risen every year since 1991. The U.S. economy was in the longest post-WAP2 expansion. Unemployment was low, inflation was low, corporate profits were growing. The data supported optimism. But investors didn't just think the market would keep rising. They thought it couldn't fall. They dismissed skeptics as outdated, as people who didn't understand the new economy. This belief allowed obvious insanity to persist. Companies with no revenue went public and traded at billion-dollar valuations. Pets.com, an online pet supply retailer, spent $300 million on marketing and logistics before generating meaningful sales. It went public in February 2000 and was liquidated by November. Webvan, an online grocery delivery service, raised $800 million and built massive infrastructure before proving demand existed. It filed for bankruptcy in 2001. These weren't edge cases, they were emblematic of the era. But during the melt-up, none of this seemed crazy. Investors genuinely believed that eyeballs and first-mover advantage mattered more than profit. Analysts published research dismissing traditional valuation metrics like price-to-earnings ratios and cash flow. They created new metrics, price to sales, price to clicks, that justified any price. And retail investors, trusting the experts, kept buying. Recency bias also explains why people enter markets at the peak. By the time ordinary investors feel confident enough to participate, the easy gains are gone. Professional money has already accumulated positions at lower prices. The retail surge happens in the final stage, right before the collapse. This isn't coincidence. It's the cycle. Retail investors are the exit liquidity for insiders. In 1999, corporate insiders at dot-com companies sold $43 billion in shares between September 1999 and July 2000. In the month before the Nasdaq peaked, insiders were selling 23 times more shares than they were buying. They knew the valuations were insane. They knew the crash was coming. But they didn't announce it. They just sold. And retail investors, driven by recency bias, bought every share. The psychological mechanism is straightforward. Humans extrapolate recent experience into permanent conditions. After watching markets rise for years, investors unconsciously assume the trend is structural rather than cyclical. They construct narratives to explain why this time is different. New technology, new economic paradigms, new financial instruments. These narratives aren't lies exactly. They're rationalizations, psychological defenses against the uncomfortable truth that markets are cyclical and that current prices might be unsustainable. Recency bias doesn't require stupidity. It requires only prolonged exposure to rising prices and the natural human tendency to see patterns where none exist. The 1999 melt-up wasn't just a speculative frenzy. It was structurally corrupt. Investment banks, which were supposed to provide objective research to investors, had integrated their research divisions with their investment banking arms. The result was systematic fraud. Here's how it worked. A tech startup would hire an investment bank to underwrite its IPO. The bank would charge lucrative fees for this service. But the bank also published research on the company. And that research was never objective. Analysts were instructed to issue positive ratings to secure IPO business. If an analyst downgraded a client, the investment banking division would lose revenue. So analysts lied. Jack Grubman, the star telecom analyst at Salomon Smith Barney, personified this corruption. He famously said that what used to be a conflict is now a synergy. He published glowing research on companies like WorldCom, which was later exposed as a massive accounting fraud. His research helped WorldCom raise billions in capital. In return, Salomon collected enormous underwriting fees. Grubman personally made millions in bonuses tied to investment banking revenue. The depth of the corruption was exposed by New York Attorney General Eliot Spitzer. Internal emails revealed that analysts privately mocked the companies they publicly recommended. One analyst called a stock a piece of junk in an internal message while maintaining a buy rating for clients. Another admitted that research was used as a tool to generate underwriting fees. The most personally revealing incident involved Grubman and Citigroup CEO Sanford Weill. Internal communications showed that Grubman raised his rating on AT&T stock after Weill intervened to help Grubman's twins gain entry to an exclusive nursery school. Citigroup pledged a $1 million donation to the school. A major stock rating influencing millions of investors was exchanged for a private family favor. This wasn't an anomaly. It was how the system functioned. The corruption had real consequences. Retail investors, trusting analyst recommendations, bought overvalued stocks at the peak. When the bubble burst, they lost everything. The banks paid fines, $1.4 billion in the global settlement of 2003, but kept most of their profits. Grubman was fined $15 million and banned from the securities industry for life. But he kept his wealth. The insiders won. The retail investors lost. The structural incentives remain largely unchanged today. While regulations now require separation between research and investment banking, the fundamental conflict persists. Banks profit most from deal flow, and positive research generates deal flow. Analysts face subtle pressures to maintain favorable coverage on potential clients. The mechanisms are more sophisticated now, fewer explicit quid pro quos, more implicit career incentives, but the underlying dynamic endures. The lesson isn't that corruption has been eliminated, it's that corruption has become more refined, harder to detect, and therefore more dangerous to unsuspecting investors who assume reforms have solved the problem. The Nasdaq peaked at 5,048 on March 10, 2000. By October 2002, it had fallen to 1,139, a decline of 78%. The wealth destruction was total. Cisco lost 80% of its market value. Oracle lost 80%. Even Microsoft, one of the few companies that survived, didn't see its stock return to its March 2000 peak until 2015, a 15-year recovery period. For the instant millionaires, the collapse was devastating. Stephan Paterno, who had been worth $100 million on paper, watched the Globe.com's stock fall from 97 cents to 20 cents. The company was delisted in April 2001. Paterno later admitted he had to borrow money from his parents to pay rent. His experience became the defining story of the era, the paper wealth that evaporated overnight. But the psychological damage extended beyond individuals. An entire generation of investors learned that markets can collapse suddenly and brutally. The 15-year recovery time for the Nasdaq meant that anyone who bought near the peak in 2000 didn't break even until 2015. That's not a correction. It's a lost decade and a half. And for many investors, the trauma was permanent. They never returned to the market. The regulatory response was significant but insufficient. The global settlement of 2003 forced investment banks to physically separate their research and investment banking divisions. It banned tying analyst compensation to investment banking revenue. It required firms to provide independent research to clients. And it imposed lifetime bans on the most egregious offenders like Jack Grubman and Henry Blodgett. The Sarbanes-Oxley Act, passed in 2002, increased accountability for corporate executives. It made CEOs and CFOs personally liable for the accuracy of financial statements and imposed severe criminal penalties for fraud. These reforms addressed some of the structural corruption that enabled the bubble. But the reforms couldn't fix the psychological vulnerability. Recency bias, FOMO, herd behavior, these are human flaws, not regulatory gaps, and they ensure that the cycle will repeat. The human cost of the collapse extended beyond financial losses. Marriages ended over investment decisions. Families lost college savings and retirement funds. Some individuals never recovered professionally. Their careers derailed by the decision to quit stable jobs today, trade during the mania. The psychological literature on the dot-com crash documents elevated rates of depression, anxiety, and even suicide among those who lost everything. The wealth wasn't just paper. For many, it represented dreams of early retirement, financial security, and escape from decades of ordinary work. When those dreams evaporated, the emotional devastation was profound and lasting. The technical setup that preceded the 1999 melt-up is present in 2024. Low volatility, massive retail inflows, concentrated market leadership. The difference is the narrative. In 1999, it was the internet. Today, it's artificial intelligence. The parallels are exact. Massive capital is chasing AI companies based on anticipated future growth. Market concentration is extreme. A handful of chip makers and cloud providers dominate valuations. Retail investors are piling in, convinced that AI will transform every industry. And skeptics are dismissed as people who don't understand the technology. But there's a critical distinction. In 1999, most high-flying companies had no earnings. Valuations were based purely on speculation. Today, the dominant AI companies, NVIDIA, Microsoft, Google, have massive revenue, proven business models, and robust cash flow. The concern isn't whether these companies are real, it's whether current valuations assume growth that can't be sustained. Analysts frequently compare today's market to 1999, but most emphasize the differences. Current valuations, while elevated, are not in the same range as the speculative peaks of 2000. The phrase "not in the same zip code" appears repeatedly in financial commentary. But this misses the point. The melt-up doesn't require absurd valuations at the start. It requires the belief that prices will keep rising. Once that belief takes hold, valuations become absurd quickly. The behavioral signs are identical. Retail investing among younger adults has surged. Many are using the stock market as their primary wealth vehicle, not a long-term savings tool. They're trading with leverage, chasing momentum, and entering the market at record highs. And just like 1999, they believe this time is different. The generational forgetting is complete. The 15-year recovery period after 2000 was long enough for a new cohort of investors to enter without experiencing the trauma. They've only known rising markets. They have no memory of the devastation. And so the psychological cycle restarts, unburdened by history. Market liquidity conditions mirror the late 1990s. Corporate buyback programs are running at record levels, mechanically supporting prices regardless of fundamentals. Retail flows, amplified by zero-commission trading and fractional shares, provide continuous buying pressure. And just as the Federal Reserve's interest rate cuts in 1998 flooded markets with cheap capital, current monetary conditions ensure abundant liquidity. The structural ingredients for a melt-up, low borrowing costs, ample liquidity, and mass retail participation are all present simultaneously. If the current setup follows the 1999 script, here's what happens next. The market continues grinding higher, driven by retail inflows and low volatility. The climb feels safe because volatility remains suppressed. More investors pile in, believing they're participating in a sustainable trend. FOMO intensifies. Then the acceleration begins. Prices don't just rise, they surge. The melt-up phase starts. It might last 6 months, maybe less. During this phase, ordinary people make life-changing money in weeks. Stories circulate of massive gains. Media coverage amplifies the frenzy. The final wave of retail investors enters, convinced the opportunity is too big to miss. And then it breaks. The collapse isn't gradual. It's sudden. A single catalyst, a disappointing earnings report, a regulatory announcement, a macroeconomic shock, triggers selling. Volatility explodes. Prices that climbed for months fall in days. Retail investors holding leveraged positions get liquidated. The wealth evaporates. The insiders, as always, exit first. Corporate executives, venture capitalists, institutional investors, they sell during the melt-up, while retail investors are still buying. By the time the collapse begins, the smart money is out. The retail investors are left holding worthless positions. The 1999 melt-up created instant millionaires. But those millionaires lost everything in the crash. The pattern isn't about creating wealth, it's about transferring wealth. From the uninformed to the informed, from retail to institutions, from the late entrants to the early movers. If the pattern holds, we're watching the setup phase right now. The retail flows are building. The volatility is low. The belief in the sustainability of the trend is growing. All the ingredients are present. The only question is timing. Maybe it takes another year, maybe 6 months. But the math says the melt-up is coming. And when it does, a new generation of ordinary people will become instant millionaires. And then they'll lose it all, just like last time. The historical record offers one final insight. Every participant believes they'll be smart enough to exit before the collapse. The day traders in 1999 thought they could see the top coming. They were wrong. The institutional investors thought they could hedge their exposure. They were caught too. Even the insiders, who sold billions before the peak, didn't fully escape. Many held significant positions that evaporated in the crash. The pattern doesn't discriminate based on intelligence or sophistication. It operates on mathematical certainty. Parabolic moves always end in collapse, and collapse always happens faster than the ascent. The only variable is timing. And timing, as every speculator eventually learns, is impossible to predict with precision. The formation is visible now. The outcome is predetermined. What remains uncertain is simply when the acceleration begins and how violent the final surge will be before gravity reasserts itself.